Hello and welcome to this interview. Money View from the Top is the series where we bring you the biggest voices in the field of mutual funds. And joining me today is a very special guest. He is one of India's perhaps most quiet, but also one of the finest mutual fund managers that we have. Neelesh Surana, who is the Chief Investment Officer at Mirae Mutual Fund. He has made lots of wealth for lots of investors, and I'm very, very happy to bring him to you here on Daily Hunt today. Thank you very much, Neelesh. It's a pleasure talking to you always. And
Thanks.
You've done a terrific job with the schemes that you manage. This interview is more for people who are in small towns and cities who want to invest. As you've seen, we've seen a large number of new investors coming into the market in the last 2-3 years, but they need a lot of guidance, and who better than you to provide that. So my first question, Neelesh, given the volatile times that we live in, and we've seen extreme volatility right from the time of COVID, and we continue to see it now due to global factors playing out, some domestic factors as well. What should an investor who wants to invest in equity, who has invested in equity, what are the 2 or 3 things according to you that she should keep in mind when she's investing in equity?
Yeah, first of all, thanks Vivek and Daily Hunt for giving us an opportunity to interact. It's our pleasure to be on this show. You are absolutely right that the volatility is being sort of unprecedented, particularly in calendar year 2022, and it's primarily driven by global factors. All of us know there is a bit of sort of regime change in interest rates. And of course, there's been huge volatility on the commodity side, oil prices. I think it's in this sort of backdrop, before I come to what the investor should do, our sort of summary view on the market is, first of all, is constructive. We believe that Indian economy is on a strong footing to face these global headwinds. And what we see is, despite these 2 sort of headwinds, we expect reasonably steady earnings trajectory over the next few years. And in fact, India, both on absolute as well as relative basis, would do pretty well for next few years. So in that backdrop, in that construct, we would advise investors to invest in a disciplined manner in equities. And they should earmark a particular sort of allocation in the equities, what you would say literally closer to equal weight, and from a longer term sort of time frame. I mean, that said, the return expectation should not be very significant. The return expectation should be relatively modest given the challenges. I would say low teens, it would be a right return expectation. And more importantly, the time frame should be at least 3 years plus, if not 5-10 years. That doesn't mean the returns don't come front-loaded. So I think the advice would be to for new set of investors to participate via systematic plans, and because that's one of the most efficient way of capturing volatility. And new investors could also look at some of the hybrid sort of offering which the industry, I think it's fairly sort of mature. I mean, over the longer term, probably in the course of the conversation, we would sort of talk about the power of compounding and the power of systematic plan over a 10-20 year window is very significant.
In fact, I want to talk about that right away, Neelesh. You mentioned about SIP, and that's been one of the hallmarks, really. We've continued to see record inflows month on month for the last 2-3 years on the SIP side. And I think a lot of people now, many people say, I've done an SIP, they don't even know it's a mutual fund. So it's become that popular, which is fine. But, you mentioned that it's a very good, efficient tool to invest. Can you explain that a bit more to our viewers, why it is an efficient tool?
Yeah. See, what happens is because of the noises in the market, people tend to look at, I mean, the lens of looking is slightly myopic, and you get influenced by near-term macro factors, etc. But SIP implicitly bring that longer-term time frame, mind frame, and time frame to invest. So SIPs are done for 5, 10 years. So to that extent, it is that's what is the best instrument. Equities are extremely good when you look from a longer term sort of lens, particularly in growth market. And if you look at, I mean, the broader indices itself, Sensex is up 600 times in the last 42 years, but of course, that's a pretty long 4 decades thing. But even if you look at, let's say, again, a longer term lens of 2020, let's say over a period of 25 years, the power of compounding gets magnified. A 10% return versus a 15% return, which most mutual funds have delivered in past. I mean, 15% return is 34x, 10% return is 10x, something like that. So the most important point about SIP, I think, is that the time frame, mind frame moves to longer term, which is which is a sort of a winning way to look at to participate in sort of equities. So I think, yeah, you're absolutely right. And investors, I mean, everyone has matured, of course, over the years, be it manufacturers, channel partners, investors, to look from a longer term sort of angle. And of course, lot of regulatory support. And I think that's the strength of the Indian market. I mean, last month number came a few hours back. SIP, I think, is almost touching 13,000 crores, 12,700 or something like that. So that's pretty good, pretty sort of good from the entire sort of the hygiene of sort of investing from equity. And then the experience of SIP over time also has been pretty decent.
You know, Neelesh, I was speaking to some financial advisors who know you well and who probably interact with you a lot more than the media does. And they told me that, you know, the one big tick mark about you is that you look at fundamentally strong companies when you are investing. And the reason I'm asking you this question is because in the last 2 years, we've also seen a large number of young people going to direct stock trading, going to cryptos. What is the power of investing in fundamentally strong companies? If you can explain that, because a lot of people or young people want that adrenaline rush, quick money, trading, speculating without understanding the risks. So can you explain why understanding risk is so important? And if somebody does want to invest directly in stocks, how important is it to look at the fundamentals? And how do you, I can't ask you to reveal all your details, that will take probably 5 more interviews, but at least some insights, you know, on how somebody can go about looking at a fundamentally strong company.
Sure. So first of all, Vivek, just to sort of correct, it's not me, which you have sort of been referring to. And that's a bit of answer to your question also. So when you invest in mutual fund, there are a team of specialists who full-time job is to analyze
you and your team. Yes.
Yeah. In the sense that you have a team of research analysts, which is the foundation of sort of understanding various businesses, the nuances of the businesses, doing fundamental research, meeting companies, and a lot of processes and to sort of evaluate and understand the business. So not to sort of discourage, but those who are not in the business of sort of understanding or full-time into equities, they should avoid direct investing in stocks. I mean, it looks very good when the going is good, but typically a lot of mistakes could be done when there are drawdowns in the market. So and that said, also you have a very efficient way of participating through mutual fund because it's so transparent, it's so cost competitive, it's so competitive, which is there are multiple players, all have to be at least to be in right tier quartile to deliver the returns, which is advantage to investors. And and it doesn't cost much. And as I said, it's very transparent and efficient. So I think the best way is to participate, to create wealth, is to participate in the mutual fund through the mutual fund route, or give it to a professional money manager. And to your question on the fundamentally, I mean, over time, we have seen that the wealth creators typically are participate when you own wealth creating stocks or companies are those when you participate into right set of business and which are run by the competent sort of management and you don't overpay for it. So all three bucket needs checks and balances. Selecting the right set of business. India is a growth economy, so you should select a growth business. Second is the character of growth as defined by return on capital employed should be higher than the cost of capital. I mean, these are a couple of the basic sort of filters on that. Then management evaluation is sort of very important. Over the last few decades, you see so much of difference in wealth creation within a sector. And one of the third, which is common, is that you should participate in the right set of promoters should be there to run the business. And Buffett says that Warren Buffett sort of says that integrity, intellect, and energy in that order is very, very important. And lastly, last piece in terms of fundamentally, I mean, right set of stock picking is also one should make sure that the value is more than the price. So the gap or the margin of safety should be higher. So these are some of the broader metrics in terms of selecting the right set of companies. But as I said, it's quite more detailed, nuanced. So you need to have a battery of analysts and managers to sort of evaluate that. And not everyone would have either time or the resources. So and those who have interest and all, they could probably put I would say core could be mutual fund, and there could be a small portion where they understand a particular industry in terms of more tactical or satellite sort of approach to that. But long answer, but I got your point that last couple of years globally and also in India, people, when the markets are good, try to participate in directly through stocks, but that should be, I would discourage that.
Neelesh, we always say that, past performance should not be seen when you are evaluating future performance. But, you mentioned earlier about performance of some of the mutual fund schemes which have been around, including yours, for over a decade, some even 20, 25 years. And if you see, there are quite a handful of them which have delivered in high teens or even in 20% plus compounded returns every year. Now I know I don't want to get into whether for the next 15, 20 years also it will be high teens or 20, maybe not, who knows. But my question is that given where India is, given where corporate India is, given the macros, the micros, do you see strong growth in India and in their markets for the next 10 to 15 years? I'm not asking 3 to 5 years, but 10 to 15 years. Could it be a great story, India?
Absolutely, Vivek, absolutely. I think both on cyclical side, which is, let's say, look at next couple of years, and also the structural side, India is very well poised, both on absolute basis and I said definitely on relative basis, given the challenges or the chaos happening in the global economy. See, on the near term, if I were to, let's say, next near to medium term, why we should do well, I think there is upturn in many large verticals or large sectors of the economy, be it housing, which has seen down cycle since 2013. We are seeing second year of upturn. Banking, corporate India is in very good shape in terms of the balance sheet strength. We are seeing consolidation in telecom. IT sector is doing well. We have seen manufacturing. There are a theme in terms of the tailwinds in China +1 and the multiple reforms, PLI, etc. And all in all, the corporate profitability would sort of stand out in terms of remain sort of resilient to face the current onset of global challenges. On your question on the longer term view, I think 10-year, 15-year view is extremely sort of positive in terms of these structural drivers for growth for this country. I mean, if I were to call out, basically the growth, why we should grow at particular range, say 6.5 or around that. the big picture, and we've seen recently the number that India is now the 5th largest economy and why we should chug along well. I think basically there are a couple of structural drivers which will give the tailwind, and these are essentially related to the demographics first, and second part is the potential on the infrastructure and the investment side. I mean, demographic, all of us know we have a favorable sort of age which would remain favorable for next few decades. Age cohorts are good. We have trends of urbanization sort of happening, increasing per capita given the low penetration level is very positive for many of the businesses. And you have this whole advent of the gig economy, which would provide incremental job. I mean, we need to provide almost 10 million jobs for next 10 years in each year. There's a huge potential. So all that means there is an inherent demand from the consumption side. And on the investment of the infrastructure side, we have, as I said, on the housing side, there is a revival, there's a potential for that. Government has laid down a national infrastructure policy quite explicitly how much investment, 110 lakh crore over the period of 5 years. And all that in terms of whether it is demographic or infrastructure, I think it's been very well lubricated by multiple reforms which have taken place over the last few years, particularly last 4 or 5 years, be it in terms of the digital ecosystem, the reforms in terms of be it GST, IBC, taxation reduction, privatization drive. So all in all, the ease of doing business has sort of improved. So I think the next few years should be much better than what we have seen last decade in terms of the overall construct, because last decade we had multiple events which are unforeseen, starting from start of the decade, the fallout of the global crisis and the oil shock, policy related issues were there. Once in a decade event like, I mean, we had, I mean, some of the experiments like demonetization, we had COVID, which is once in a century sort of event. So all that is sort of unlikely to repeat. So I think that growth would be pretty decent in the construct, in the sort of environment, particularly when globally there are very few pockets for growth, which would attract foreign capital also, and also domestic capital. So all in all, I mean, that I don't want to, one should not have a very high expectation. That's why, but if you're keeping an expectation of around low teens, extra could be a bit of bonus, but around low to mid teens, I think returns over the next decade or more should be pretty, should be sort of be in that range, yeah.
Neelesh, you know, we saw a massive pullout by foreign investors, portfolio investors, and you know, yet the market stood firm and withheld because of the domestic flows. And now we see a slight turnaround where, of course, we've had 1 month of very good numbers, but it looks almost like that kind of money is going to come back. When that happens, you know, do you see in the near future as well, you know, a strong growth? You know, of course, we hit a high of 62,000, went down to about 51,000. We are almost back to kissing 60,000 odd. But, you know, the kind of, now that we have domestic flows and we are having the foreign portfolio investors also coming back, could that give a good momentum to the markets according to you?
Yeah, so Vivek, the point is that this is a slightly tricky thing because anticipating flows in the near term is very, very difficult. And that's not the best way to invest. But your observation is absolutely right that the drawdown which we saw in the current calendar year and the subsequent rebound is primarily driven by FII massive selling. They sold almost close to 2 lakh crore, and there is a reversal of about 45 to 3,000 crores. So I think FII ownership at the highs last year was around 21% in terms of the overall ownership. It went down to 17, and now it's around closer to 80%. But as I mentioned that, I think that flows should be steady from both the buckets from a medium to longer term. The reason is even for foreign portfolio investors, I think the positioning, first of all, is at lows. It's not at highs. There is already a reduction there. And given the, as I mentioned, it's basically money comes where the growth and earnings prospects are. So given the relative strong strength of India compared to various emerging markets, we should get steady flow over a period of time. It's very difficult to say the near-term thing. And as we touched upon, the SIP piece, which is essentially a longer-term sort of allocation to equities, would remain steady. So purely on account of flows, I don't see a very sort of significant worry on that front. Of course, we saw that what happened in the first half driven by global factors. Also, I think related to flows, not related to equities, but flows more onto related to the macros. I think there is a potential that there are talks that India's inclusion in global bond indices could happen soon. And in that case, I think FI participation in the fixed income market could also result in significant capital flows from FY24 onwards, which is positive for the overall macros.
My final question, Neelesh, we are seeing a lot of NFOs these days. So while, of course, on the one hand, there are a lot of new mutual funds who have got their licenses, so they have to, come out with NFOs to start their business. But there seem to be a flood of NFOs. And my question is, what are the factors or the key factors that an investor should keep in mind before investing in an NFO?
Sure. So, Vivek, I mean, the NFOs are for the companies if they want to fill the gaps in their sort of offering, or as you mentioned, newer AMCs coming in, then definitely they will have to launch the business via NFOs. So there is, from an investor's lens, frankly, there is no distinct advantage that you have to necessarily participate in an NFO, because the industry is very well dissected and over time in terms of performance, what is the type of the portfolio, etc. So a large allocation to NFO necessarily, unless it's a very differentiated product, need not necessarily to be done by sort of investors. But as things sort of stabilize, this fairly, as I mentioned, is a very competitive industry. And based on the right to win of a particular AMC or a particular product within the AMC, over time, there is enough data. There are external agencies, there are experts like you, there are external which sort of rate the fund. I think subsequent to after say 3 years, 5 years, one should sort of evaluate and participate in the mutual fund.
It's been a pleasure talking to you, Neelesh Surana. Thank you very much for taking time out and speaking to viewers, millions of viewers here on Daily Hunt. I look forward to many more conversations with you. Thank you.
Thanks, Vivek. Thanks, Vivek and Daily Hunt. And it was my pleasure to interact. Thank you.